Happy morning, people. Hope you're all doing good. So, in the today's section, we'll be covering MTP 1 of May 2024. Okay. Again, if I have to tell about the overall MTP, it's pretty straightforward, sir. The only 4 questions have been, you could say, newly added. We can learn some few extra things from them. Other than that, it's pretty much the ditto questions as available in our the class notes itself. So one good news for you, all the MCQ questions, sir. There are about 3, or in fact 4 MCQ questions. All the MCQ questions we have already done, like here reference. So we have done a video, it's available on YouTube also, case-based MCQ video. So this case scenario 1 is MCQ number 9 in our class notes, okay, that particular video. Next particular case study is, a case scenario question is case-based MCQ number 10, which we have done. Okay, those of you, even if you have not taken class, it's okay. On the YouTube, we have released a video called case-based MCQ question by me, Sandesh, by the way. Yeah. So you can search MCQ number 10 is the same question, not even anything different there. So this case scenario number 3 is MCQ question number 8. So basically MCQ 8, 9, 10 is what we have done in that video. That's same 3 cases is available here, sir. Okay. And this particular case number 14, we have done one more series on MTP 2. The same question is there. Here they've asked only initial measurement, and there we have done subsequent also. So this is also in a way covered. Question number 15 is pretty much straightforward theory MCQ. You can go through it for yourself. Okay. So as such, MCQ there is nothing new to learn from for us. So everything is pretty much already covered. So now some descriptive question, 4 questions is what we need to cover. That's, you could say, the new questions here. Right. Question number 1 is slightly different. Yeah, we'll be taking up this particular question. So without delay, let's get started. On 1st April 20x1, J Limited acquired new subsidiary B Limited. So J is the parent, B is the subsidiary. 1st April is the date of control. Purchasing all 150 million shares of B. So 100% acquisition it is. So that means there is no non-controlling interest in this particular subsidiary company. The terms of the sale agreement included exchange of 4 shares in J for 3 shares acquired in B. So we have acquired, we have to give PC, no? PC is given in the form of share exchange ratio. We will give 4 shares for every 3 shares exchanged. Okay, old, you can call it as new. For 3 shares acquired, the purchasing company will give 4 new shares. And how much does the subsidiary company have total shares? They have 150 million shares. For 3, if you are issuing 4 means, for 150 million, how many shares? That's what we need to calculate. So it will be 150 million into 4 by 3. If you do cross multiplication here, it will be 4 by 3. So if you do this, you'll get the number of shares given by the parent as a purchase consideration. But we don't need the number, we need the value. Do you know value of each equity market value? Yes, on 1st April, on the date of control, the market value of shares of the parent company is 10 rupees. Market value of subsidiary company is irrelevant because parent is issuing the shares here, and parent company ka market value of the shares on the date of control is 10. So multiply by 10, you will get the value of shares given as PC, which is 2000. All these numbers are million because they've given the data in million. So we'll present in million itself. So 2000 million is the one part of PC because we could have other parts also. No? We'll see. The terms of the share purchase agreement included issue of 1 additional shares in J Limited. Okay, other than the normal above share exchange, extra PC is given. In what form? 1 additional shares in J Limited for every 5 shares acquired. For 5, we are issuing 1. And how many shares does the subsidiary company have? 150 million. So the number of shares will be 150 into 1 by 5. If you do, you will get the number of shares issued. Okay, but is it straight away given? No. We are giving 1 additional shares for every 5 shares acquired in B if profits of B Limited, that is subsidiary company, for 2 years ended 31st March exceed the target figure. So this particular is also PC only, but we will give the shares only if certain targets are met. The profit targets have been specified that they're not called out, but that's okay, right? Only if that particular target is met, we'll issue the PC. This only we call it as contingent consideration, mainly because this is contingent or dependent on a certain parameter or a target getting satisfied. Yes, this only we call it as contingent consideration. Is contingent consideration a part of PC? Yes. We also take fair value of contingent consideration on the date of control, and that is also a part of PC. Yes, PC can be given in the form of cash, equity shares, fair value of existing shares, correct? Or prorated SBPR, deferred consideration, contingent consideration. All this we have studied in India's 103 business combination, the types of PCs. So here, contingent consideration is that. Are they given? Should this be a part of PC? Yes. Okay, so have they given? Yes. The current estimates are it's that 80% probable that the management will achieve this target. So we have a good enough chance that we will achieve the target. Okay, they're not given fair value. Usually contingent consideration ka fair value will be specified to you in the question. Here they're not specified, so it's okay. All right, so if you do 150 million into 1 by 5, you'll get the number of shares, but we want value. Who's issuing the shares? Parent, and parent ka value, fair value of each share is 10 rupees. So multiply by 10, you will get 300 rupees. Okay, sir, like this. Okay, but in my view, you could also multiply this by 80% also and taken it as 240. That would have been better. Because no, this is what, sir? We want fair value of contingent consideration on the date of control. Okay, right? So this shares will not be issued now. It will be issued whenever the targets get satisfied. That too after 2 years. So we don't know that, right? So current value of that could be a lot lesser, but it's okay. I say since they're not given the value, they've multiplied by the current market price and taken the value. Let's do the same thing. This is how the mother body has taken. Okay. So we'll also mother ICI. So we will stick to the same presentation. Okay. So if you do this, you'll get number of shares, and the fair value of one share on the date of control is 10. So you will take that to be 300 million is the fair value of contingent consideration given in the form of shares. Should this form part of PC? Yes. So adding these two, you'll get the total PC to be 2,300. No other thing is there, sir? No, we'll see. Most probably no. The legal and professional fees associated with acquisition is 12 lakh. Sir, all these are transactional costs. And India's 103 clearly says that all the transaction costs will be transferred off to SPL. So all this will go off to P&L account, including 2 lakh, all this. So entire cost, whatever they have given, all these are acquisition costs. All acquisition related cost or transaction cost goes off to SPL. So all this is irrelevant for me. Okay, because the requirement is you just need to calculate few things, sir. You just need to calculate goodwill over here. That's all. Okay. What is the value of goodwill on the date of control? So this becomes irrelevant. The individual balance sheet of B Limited subsidiary company on 1st April 20x1 on the date of control, that is, comprise net assets whose fair value on that day as in date of control. So we need a fair value of net assets on the date of control. That is given to be 1,200 million. Great. Additionally, J Limited considered B Limited possessed a certain intangible assets. Subsidiary company, they have some intangible assets, but they were not recognized in balance sheet. Subsidiary company do have some intangible assets, but they are not showing it as intangible assets. Why? We'll see. One is customer relationship. Okay. A reliable estimate is 100 million. Normally, when you do business, you acquire customer data, right? Now we give coaching, right? As part of our coaching, we get students' data, right? Their mobile number, email ID, name, or whatever, right? Did we pay anything for it? No, but we still got it as part of our business. So you cannot recognize. Okay, you can't necessarily say how much cost was spent to acquire. Now, if you ask us how much cost we spent to acquire students' data, we can't say anything. Yes, no, because we didn't spend any money towards that. We are offering coaching. As part of coaching, when somebody subscribes, they give us some data, right? Name, number, etc., etc. So that comes as part and parcel of business. So hence, cost measurement becomes a problem over here. Hence, in individual financial statement, these sort of intangible assets, okay, will not be recognized. That's the reason they're not recognized. But if our company, let's say Arigo Pro, got acquired by another company, right? Some other company purchased us. Obviously, since we have a lot of database, there will be a value for that database also. So that means the PC that would have been paid, will be including of this. Okay. Subsidiary company, though they have not recognized these as intangible asset, but for goodwill calculation purpose, for PC purpose, even these should be considered. But right now they are not accounted. That means we can't take fair value of net assets on the date of control to be 1,200. Few things are not considered. One is customer relationship. And how much is the fair value? 100 million. So we want net assets. The fair value of net assets on the date of control. The given value is 1,200. One intangible assets they are not recognized. So add it. It's an asset, no. When you recognize an asset, obviously net asset balance will increase. Net asset is nothing but assets minus liability, right? So if you are recognizing one more asset balance will increase. So hence add this. Such question we have done. Okay, in our India's 103 we have done. So it's not really new to us, but just in case for the benefit of the YouTube audience, explaining little further. That's it. And in-process research and development. So can you capitalize the research expense? No. But can you capitalize development expenditure? Yes, provided certain conditions are satisfied, which we used to sum up as TIFRC. Technical feasibility, intention to complete, ability to use, future economic benefits, correct? Financial, technical, and other resources, cost measurement. So all this only we used to call it as TIFRC, right? If you remember, yes. So if TIFRC is satisfied, you will capitalize development phase expenditure. Otherwise, development phase expenditure goes off to SPL. So here we have some development phase expenditure which is not recognized. Not recognized because TIFRC has failed. Okay, since the necessary condition, which is TIFRC, were not only satisfied. Okay, however, the fair value of that project is the research and development phase expenditure is 550 million. So in your separate financial statement, you have not recognized this as intangible asset because TIFRC is not satisfied. But now, when some other company parent acquires subsidiary ka shares, even this also will be considered when determining the PC. So hence, should this be considered for goodwill calculation, for net asset calculation? Very much yes. So add this research and development phase expenditure of 50 million also, because subsidiary has not recognized that as net assets. That's the reason. Employee expertise. So employees, human beings are not assets, right? So human beings, they're saying the fair value of the directors and other employees is 80 million. Human beings will not recognize as an asset because there is no control over it, right? It fails the control feature, and human beings are not recognized. We assume that whatever amount is paid for the human beings, it's already included in the value of goodwill. Okay. So human beings, you cannot show it as intangible assets. I've just written it for your reference over here, but don't take any value. All right. So after doing all this adjustment, the fair value of net assets, the revised fair value of net assets on the date of control becomes 1357. Now we can straight away calculate goodwill also. How do you calculate goodwill? Take PC, which we already calculated, 2300. It's 100% acquisition, so NCI is 0, minus fair value of net assets on the date of control, which we got it to be 1350. Reduce that, you'll get goodwill on the date of control. They only ask the goodwill on the date of control, so the answer is 950. That's it. Okay, a very straightforward question. Similar one we have done. Okay, all this. Maybe this particular portion was not there. That's the reason I covered this. All this and all is pretty much we have done it. Done, sir. So this is one new question you could say from this particular MTP. I believe I can move forward. Okay. Question 2A, the same question you will see it as illustration 16 in days 109, a repetitive question. 2B is available in India's 1 as question number 24 in our class notes. So when I'm telling you the question reference here, it's from the regular notes and not from the fast track. Fast track also it may be available. Okay. Next. Next is your 3A, sir. 3A, 3B you could say are a new question. So you can learn something from them. We will cover them. Just 1 second. Okay, question number 3A, sir. LT Limited is in the process of constructing a building. This is about India's 23 ka borrowing cost wala question. Good one, I could say. LT is in the process of constructing a building. The construction process is expected to take about 18 months. So it looks like a long period of time. So then this building could be considered as is considered as a qualifying asset from January 20x1 to 30th June 20x2. It's going beyond 1 year. The building meets the definition of qualifying asset. Great. They've incurred the following expenditure for building construction. On 1st Jan, 5 crore, 30th June, 20, 31st March, 20, 30th June, 5 crore. If you add everything, you'll get 50 crore. That was totally spent towards construction of a building. On 1st July 20x1, read this line carefully. On 1st July 20x1, LT Limited issued 10% redeemable debentures for 50 crore. Okay. So debenture, it's a borrowing. It's not necessary borrowing has to be in the form of bank loan, right? Even debenture is a borrowing. So probably to finance this construction of building, the company has issued debentures. But they've issued the debentures on 1st July, that is one. And these are 10% debentures for 50 crore. The proceeds from the debentures are part of company's general borrowing. Oh, they're saying this is not a specific borrowing. This debenture is a general borrowing, which it uses to finance the construction of qualifying assets. So this particular general borrowing is used to find out or is used for construction of a building. And we know whenever we have a general borrowing, we need to find out weighted average capitalization rate. The company LT Limited had no borrowings, general or specific, before 1st July. So before 1st July, they're saying the company does not have any borrowing at all. Okay. All right. Great. That gives us one point may has to make us clear. So we started construction on 1st January. All right. But borrowing has come only from 1st July 20x1. So January, February, March, April, May, June, about 6 months, the construction had already started. On the 7th months of construction, basically the borrowing has come into picture. Okay. Meaning probably the company had enough money with them. That's the reason there was no necessary for them to borrow the money in the first 6 months. Or they were trying to take the borrowing. It took some time. We don't know what's the reason. But basically the borrowing came only in 1st July. That means what? Any borrowing cost, right? Before 1st July, you can't capitalize anything because there is a conditions for borrowing cost capitalization. No? The day on which 3 conditions are satisfied, that day you can start borrowing cost for capitalization. 1, borrowing cost should be incurred. 2nd one, expenditure on qualifying assets should be incurred. 3rd, the activities relating to qualifying assets should have begun. The activities for this purpose includes your planning and administrative activities also. So here borrowing cost starts only from 1st July. So capitalization starts only from 1st July, nothing before that. Why am I stressing on that word is they've asked, well, how much will you capitalize borrowing cost for 3 years over here? this way. Normally, in majority of the questions which we have done now, we have done these sort of questions. The thing is, normally when the questions we have seen in our class notes, no, we used to prepare or we used to calculate the borrowing cost capitalization data only for 1 year. All right, for 1 year, what is the borrowing cost to be capitalized? That's how usually the question used to come. Here they're asking the borrowing cost capitalization for 3 years. 31st March 20x1, 1 year ka. 31st March 20x2, how much borrowing cost? 31st March 20x3. For 3 years, how much borrowing cost will you capitalize is what is the requirement. Okay. Since borrowing cost came only in 1st July. Alright. First, so we can definitely answer off. For the year ended 31st March 20x1, there is no borrowing at all. On 31st March 20x1, we didn't have borrowing. Borrowing itself came on 1st July. Right. So for the first year, there is no borrowing, hence no borrowing cost will be capitalized. That is one part of the answer. Okay. See, even if this question was entirely, little different to you. Okay. If you read and it didn't make sense, right? Suppose it has come for like here 8 marks, right? If you just check. But the first part of it is very, very easy, no, sir. That much though is common sense, no. You can easily tackle this much. If you are not able to tackle second and third year because you have not done it, that's okay. That's understandable. If the same question suddenly comes in examination, it's entirely new. But at least if you do this part properly, you'll get 2 marks. See, in this 8 marks also, all right, there is a scope to calculate or score 2 to 3 marks. That's where you should focus on. Even if the question is entirely new, all right, there will be 1 or 2 adjustments which will be very straightforward from that question. So at least if you do that, instead of getting 0, you will get 2 to 3 marks. And that's where you need to focus on. Okay, the more you are open or you keep your mind towards that opportunity, better chances are there for you to score exemption or clear that particular paper and eventually the group and probably eventually become chartered accountant. So be focused towards that. The moment you read one question, don't say, oh, you know nothing, I know, going. Okay, not necessarily. Some part of the adjustments in the very tough question also will be straightforward, which you can score. Like here, this is, if you do, I'm sure you'll get 1 or 2 marks easily for that. Okay, moving along. Then what does it say, sir? L&T had no borrowings before 1st July and did not incur any borrowing cost before that date. LT incurred 25 crore on construction cost before obtaining general borrowing. That was pretty much we know. No. Borrowing cost came only on 1st July. Before 1st July, these 2 expenditure already incurred. See, this came in 5 crore, this came in 20 crore or 30th June. So before borrowing came only, these 2 expenditures are already included. That is 25 crore. Okay. And 25 crores is incurred after obtaining the general borrowing. Okay, because total construction cost is 50, no? Right, that's what they've said. Out of 50 crore, 25 was incurred probably before borrowing cost come into picture and 25 after borrowing cost has come into picture. For each financial years, that is for 3 years, year ended 31st March 20x1, x2, x3, calculate how much borrowing cost can you capitalize. That's simple. Okay, it's a very straightforward question if you ask me. Very simple only, but it looks a little fancy. I think first year ka treatment, I think all of you have understood and thinking. Yes, no? There was no borrowing cost in the first year, so hence borrowing cost for capitalization also will not arise. That is over. Now, sir, now if you just check, normally whenever there is a general borrowing, we need to calculate weighted average borrowing cost. But the irony of this question is, sir, they have given only one borrowing, right? That is what? A debenture. And this debenture ka rate is what? 10%. Yes or no? Correct? No. So where is the question of weighted average borrowing cost for that? Sir, if you have multiple at least, 2-3 loans, we can use that data and calculate. Yes, no. But here it is what, sir? Only one borrowing. So that means you don't have to put up any working note for calculation of weighted average capitalization rate because it's only one rate, no, 10%. We will straight away use that and accordingly do it. We have to assign weights, but I'm saying weighted average capitalization rate separately need not be calculated because there is only one borrowing. Okay, so that is also sorted. Okay. Now, I hope that is clear, right? For second year, the second year ended 31st March 20x2, what you have to do? So you can present answer in one liner like the way I've done it over here, or you can do your old approach. Okay, maybe first I will tell you the simple approach and then probably, or maybe we'll go for the other one only, better maybe. The second year, if you have to capitalize, check, sir, second year is ending on 31st March 20x2. Now, when did you take this borrowing? Second year means I will talk about second year is ending on 31st March 20x2 means the period will be what, sir? 1st April 20x1 to 31st March 20x2. This is the period, no? Correct? Alright. Sir, did you take the borrowing on 1st April? No. Borrowing came only on 1st July 20x1. That means April, May, June. Borrowing was not there. Sir, this is general borrowing means we have to use weights. No, the weightage here is what, sir? 9 months into 9 by 12 you have to do over here. Understood, everybody? Why 9 by 12 again? So, though the current year is for 12 months, okay, you took the borrowing only on 1st July. That means 1st April, May, June. For 3 months in this year, borrowing was not there. So weightage here you'll give, here the weight you will give it in months, right? So here you'll do 9 by 12. Comfortable, sir? Okay. Now, what and all was there? We are in 31st March 20x2 now. Till 31st March 20x2, what and all expenditure you have incurred? Check. 31st March 20x2 here, no? Before 31st March 20x2, what and all expenditure you have incurred? Okay. Sir, you don't have to check when this expenditure is incurred. Under the general borrowing concept, no, whatever expenditure has been incurred, no, that you assign the weights. You calculate time weighted expenditure for them. Okay, you don't have to worry from, normally we don't worry this 5 crore came from what borrowing, because we can have multiple borrowings, right? So we'll not worry this 5 crore came from there, whether we used our own money, whether it came from general borrowing, it came from which general borrowing, like that we'll not worry. We'll just calculate the time weighted expenditure. Till 31st March 20x2, what and all expenditure have you incurred? This 5 crore, is it incurred? Yes. Okay, that you've incurred much before. Last year only you've incurred that. But year is irrelevant. For current year, what is the weightage? 9 by 12. So how much expenditure you've incurred here? 5 crore. So take 5 crore into 9 by 12. You do. Alright, that is this. Doing this, you get time weighted expenditure. Multiplied by what, sir? Weighted average capitalization rate, which in this case is 10% only, because we don't have multiple borrowings. Like this. So this, if you do, you will get borrowing cost to be capitalized 0.375. So you don't have to worry about when this particular expenditure specifically is incurred, or it came through which general borrowing, or whether it came through our own cash balance. Like that, we don't have to worry. You have to just check what expenditure is incurred till the current year ended 31st March 20x2. Till 31st March, these three are already incurred. Okay. So hence take 5 crore, and the weightage for this year is 9 by 12. Why 9 by 12? Because for this year, we have taken the borrowing only on 1st July. So from July to end of the year, if you count, that is 9 months. So hence 5 crore into 9 by 12, if you do, you'll get time weighted expenditure multiplied by the weighted average capitalization rate, which is 10% if you do. This is the borrowing cost capitalized. Same thing you'll have to do it for the other one also. Now this 20 crore came from what? 30th June 20x1. Yes, no, 30th crore. So that means same, 20 crore. Okay, it came on 30th June only, but that's okay. From June 20x1 to, if you count 31st March 20x2, obviously it is 9 months. Here anyway, weightage you will give it for 9 months. But this expenditure of 5 crore is incurred in 1st January, no sir. That means the weightage will be 15 months, no sir. No. Since the borrowing itself came in 1st July, right? So the maximum weightage you can give here for this calculation is only 9 by 12. Maximum will be 9 by 12. You cannot go beyond that. Okay? Because borrowing came only in July. So July to March if you count, because current year is ending on March. The weightage is what? Only 9 by 12. Though this expenditure, you might have that doubt. This 5 crore has been incurred in 1st January. So if you calculate from 1st January 20x1 to 31st March 20x2, it is 15 months. No. Since the borrowing has come from July, count it from July to end of the March. Okay. So the first starting date is July or later. The ending date is 31st March. So maximum weightage is only 9 by 12. So this particular 20 crore you have incurred on 30th June. So you can start counting from July. So 1st July 20x1 to 31st March 20x2, if you count, again it will be 9 by 12 only. So 20 crore into 9 by 12 if you do, you'll get time weighted expenditure, that multiplied by weighted average capitalization rate, which is 10% if you do, you'll get 1.5 crore. That is the borrowing cost you can capitalize. Okay, sir. Now the third one. Till 31st March 20x2, have you incurred one more expenditure? Yes, you have incurred 20 crore. So this 20 crore also you do 9 by 12. You should not do, sir. Why, sir? Sir, we calculate time weights. Our current year is ending on 31st March 20x2, and you incurred this expenditure on 31st March 20x2 only. On the day our year is ending, on that day itself, we have incurred 20 crores. So that means weightage is what? Don't come from July. On July, May 20x1, July 9 by 12 is from July to March. This expenditure is not incurred in July. It is incurred in 31st March only. And year is ending on 31st March 20x2. So you will take the amount, I've shown it for reference. The weightage is 0 by 12 because on the last day of incurred the expenditure into 12%. Okay, sir. This if you do, obviously you'll get 0. So total borrowing cost that you can capitalize in the second year is 1.875 million of crores or whatever it is, crores. That much. Okay. If you want, you can calculate and show like this, or you can write it in one liner. Simple mathematics. On this, you cannot capitalize anything because the weightage is 0. Now these, if you just check, here also 9 by 12, here also 9 by 12, here also 10%, here also 10%. So instead of calculating it separately, what you can do? Take 5 crore, take 20 crore, sum it up. How much you going to get? 25 crore. So borrowing cost that you can capitalize for second year is what? 25 crore. Okay. Into what? Into 10% into 9 by 12. If you do 1.875 crores. It's the same answer you will get. Okay. This is assigning the weights for all the expenditure. That's what we used to do in our regular class. Okay. You can follow that method, or if you want to save a little time, okay, you can also present like this. Here the period is only 9 months. That's what I've written here because borrowing came only on 1st July. And here is ending on 31st March 20x2. So the maximum weightage you can give only is 9 by 12. That's all. Okay, sir. Presentation is your call. This is about the second year. Second year, you can capitalize totally 1.875 crore as the borrowing cost. Done. Third year. Third year, sir. So our third year is ending on 31st March 20x2. Okay, 31st March 20x3 rather. But hang on. Sir, your year might be ending on 31st March 20x3. But when? Sir, you will capitalize for the whole year. Oh, no, sir. For capitalization of borrowing cost, there is a cutoff. There is a cutoff window that we call it as cessation of borrowing cost. Cessation of borrowing cost means to putting an end to capitalization. When will you end the capitalization? When qualifying asset is substantially complete. That is the day on which we stop capitalization. Yes. So here the construction went on only till 30th June 20x2. 30th June 20x2. So current year, third year is ending on 31st March 20x3. So the year will be 1st April 20x2 to 31st March 20x3. This is the whole year. For entire 12 months, can you capitalize borrowing cost in the third year? No, sir. So borrowing cost itself, the qualifying asset is ready by 30th June 20x2. I didn't say. Question is saying the borrowing cost or the qualifying asset is ready by 30th June. That means what, sir? What is the weightage? Current year begins on April. Qualifying asset is ready by 30th June. That means the maximum weightage here you will give is what? 3 months. That is 3 by 12. Understood? The maximum weightage you can give for all expenditure here is 3 by 12 because the asset is ready by 30th June. That's the reason. Okay, sir. All right. Now they take the data as 30th June 20x2. Okay. Has this expenditure incurred before 30th June 20x2? Yes, 5 crore. All right. So can you take this? Yes, because we don't have to worry where this 5 crore came from. Whether it came through which general borrowing, whether it came through cash and all is irrelevant. Take 5 crore. Okay, multiplied by what? Don't take 12 by 12 over here. For the third year, the maximum weightage you can give is only 3 months. Why? April, May, June. Because 30th June asset is ready. So into 3 by 12 you do and multiplied by WACR, which is 10% only in this case. That will give you 0.125 crore ka capitalization amount of borrowing cost. Next, what expenditure you incurred? 20 crore. Is 20 crore incurred before 30th June 20x2? So we have already capitalized the borrowing cost on this in last year only, sir. Why will we have to capitalize again? Sir, all this amount, all this construction amount has come through loan, right? Loan will be only for one year. No, loan period will be more than what, sir? 1 year, 2 years, 3 years, 5 years, 10 years, whatever. Yes or no? So hence, it is not just one-time calculation. Just because you have done the calculation last year, it doesn't mean that we will skip it off in this year. Because what, sir? Borrowing cost means the interest that you pay on loan. Will you pay the interest to bank loan only 1 year? No, you will pay the interest for the term. The term is bank loan is 10 years means for 10 years you will pay the interest. Yes, sir. So again, on all these amounts, every time you have to go on calculating them. Okay, by keeping the weights in mind. For this year, the weightage is 3 by 12. That's all. Okay, sir. So you don't have to worry about that. Okay, it's not a one-time thing, it's a regular thing. Yes. So on this 5 crore, we already calculated. Is this 20 crore incurred before 30th June 20x2? Yes. So on this 20 crore also calculate. Maximum weightage is 3 by 12 because this is incurred much before our current year. So hence, maximum weightage we can give is 3 by 12. Into WCR, 10% if you do, you'll get 0.5. Next 20 crore also you have incurred before 30th June only. So you can capitalize them. So 20 crore into 3 by 12 because weightage maximum is 3 by 12 into 10% will give you 0.5. Okay. Now, this particular 5 crore, can you capitalize? Yes, no. Why, sir? This particular expenditure of 5 crore you have incurred on 30th June 20x and qualifying asset is ready by 30th June. The cutoff period is 30th June. On 30th June 20x2 only you have incurred this expenditure. That means will you assign 3 by 12 here? No. On the day qualifying asset became ready, on that day you incurred this 5 crore. Okay. So hence the weightage for this will be what? 0 by 12. Into what? 10%. Anything multiplied by 0 obviously will give you 0. So like this, for each expenditure you can assign weights and calculate and you will get the total borrowing cost to be 1.125, or you can, in the interest of time, you can sum up also. If you just check this, you cannot capitalize, so cut off in your calculation. For all other things, if you just check, you're doing 3 by 12 into 10%, 3 by 12 into 10%, 3 by 12 into 10%, 3 times you're doing. No, instead of that, just add these three numbers. What it will be? 5 plus 20 plus 20, it will be what? 45 crore. So take the 45 crore into 10% and the maximum weightage for third year is 3 by 12. Do that, you will get the same answer. This is one-liner answer if you are comfortable, or you can stick to this. Or if you don't want to do like this, if you remember, we used to put up table, like, okay, we used to call it as expenditure, then time weighted expenditure and all we used to call it. Like that also, you can put up a table and calculate for each year. The way you want to present is totally your call. Okay, this is a little more descriptive with explanation, or this is just in one-liner. The way you present, absolutely your call. Okay, so along with this, maybe if you can present like this, and then you can probably write 1 or 2 words like what is the provision for borrowing cost capitalization, what is the provision relating to cessation of borrowing cost. Like those 2 provisions you write and show this calculation, that should be good enough. Okay, So these are the respective borrowing costs that you can capitalize for the respective years. That's all they ask. Nothing else in this question. Okay, so if you just check, hardly one line can answer. But you can actually present a little more descriptive like this in case you feel that sometimes when we write one line answer, no, we'll get a doubt in our mind. But this is sufficient, will I get full marks? And so if you are in that category, you can follow this presentation so that the solution looks a little lengthy and you will also psychologically get a little extra satisfaction or some tasalli or some benefit that, yeah, you will get the marks like that. Some confidence you will get. Okay, so that's about 3A. Good question in my view, if you ask. Okay. 3B. This is also a good question. We shall do this. So I put up all the solutions that because I wanted to save your time, because I know that most of you will go through all these questions in the last moment. Okay. So if I start solving and doing, in fact, I say it doesn't present the solution in the same fashion. They put up, they explain, give a whole lot of explanation. They'll make the solution 1.5 pages. Okay. All that I've just tried to simplify as much as possible. But I didn't want to write all this and solve with you here because it will take, instead of maybe now we have taken 30 minutes so far. Right. So now instead of 30 minutes, if I start solving each of them and writing, instead of 30, it will become 1 hour. So I didn't want to waste time at the last moment. So I've done this kind of adjustment in this regard. Hope that's fine. All right. 3B, next question we'll go through. Okay. So this you could say is a good question because it has multiple concepts. One, Ind AS 21 also it targets effects of changes in foreign exchange rate. Okay. That's standard, as well as Ind AS 109 accounting of financial asset is also getting tested over here. We have done the similar questions, especially in Ind AS 21. I've solved this sort of question. At least I remember solving these sort of questions. Okay, but they've added one new adjustment. Okay, one new component they've added. Due to that, this question you have to do some extra step. Whatever we used to do, same thing along with that, certain extra step you need to do. And because of that, I'm taking up this question. Don't worry, we will go through the whole of the solution. So I'll not just discuss only the extra adjustment. The whole solution we will go through. A simple one only, in fact, but a good one. An Indian entity whose functional currency is rupees, fine. It purchases a US denominated bond. So they have purchased. So if they have purchased a bond, so obviously it's a financial asset. So at a fair value of $1,000. Okay, they have purchased. Initially, all the financial assets are recorded at fair value, right? So they have only given the fair value to be $1,000. That's the initial measurement of this financial asset. The bond carries a stated interest. Stated interest means obviously how much interest you will receive on this investment. That is 4.7% per annum. So that is irrelevant for us. This is the interest which you will actually receive. We will not worry about that because we book the interest income or interest expense for that matter using effective interest rate, EIR. Yes. So this is the actual interest rate that is irrelevant for us. We need EIR. Most probably they'll give it to you in the question. We'll see. But the interest, mind you, you will receive at 4.75% on the face value. Here we have purchased the investment at fair value. Fair value and face value need not be same. Okay, it could be same. It need not be same also. Okay, but interest is always calculated on the, like dividend, interest is always calculated on the face value. Usually it's on the paid up value, but paid up value and face value in majority of the cases will be same. The said interest is received at year end. Okay, fine. At every year end, so one payment you are receiving. Okay, at every year end you will receive full year interest. Bond has a maturity term of 5 years. Great, and is redeemable at a face value of 1250. So now they have given the face value here. See, interest is calculated on face value. The face value is 1250. Great. The fair value of the bond at the end of year one is 1060. They have given the fair value. Okay, not at the year beginning. This is the fair value when you purchase the bond. Okay, that is the initial measurement. They're saying at the end of the year, the fair value of US dollar is 1060. So why do we need that, sir? Because bond is measured at ACM method, no? Amortized cost method, no? Hang on, we'll see. Yes, there is a business, we have a test for that, no? Right? We have a business model test and CCF test. If the business model of the financial asset is to hold it till maturity and collect all the contractual cash flows, then we apply ACM method, right? Or if your business model of the entity is satisfied both by holding and by selling. If opportunity arises, we'll sell off. Like that, if that mentality or if that intention company has, then we'll not apply ACM. We will go for FVT OCI method, right? If you're following FVT OCI method, then we need a fair value because bond is measured at fair value at each year ending. So here they'll give fair value. That's probably an indication that on this bond, we have to do FVT OCI valuation. We'll see. The exchange rate, since obviously all these are foreign currency transactions, we need to convert, right? So our functional currency is rupees, but we have done this transaction in US dollars. So we do all accounting in functional currency. From dollar, we need to convert it into rupees. For that, we need Ind AS 21 ka provision. So we know this. What is that, sir? So initially, all the transactions are recorded as per Ind AS 21 at TDSR, transaction date ka spot rate. All settlements are recorded at settlement date ka spot rate. In between this transaction and settlement, if your year ends, then you need to check what sort of an item does the foreign currency account have a balance, right? Whether that foreign currency account which has a balance is a monetary item or a non-monetary item. All monetary item are restated in your balance sheet using closing rate. Non-monetary item, you have to check how it's valued on. If non-monetary item is valued at cost, then you have already converted using TDSR. So no further restatement or conversion is necessary. You can use the same TDSR. However, if you are valuing this non-monetary item at a fair value or NRV, PP is an example of non-monetary item. So PP, you can go for revaluation model. That means you will use fair value. So if non-monetary item, if it is valued not at cost, but some other basis like fair value or NRV, then on the day you found out NRV or fair value, that day ka exchange rate we need to use and restate. And the exchange gain or loss will be as per the respective Ind AS we had studied, right? So if you are getting revaluation gain, you will transfer it to RR. So the exchange gain which is arising due to revaluation also will be adjusted with RR. Like that we had told the dream. Yes, sir. Okay. Now we have purchased a bond. Right, no sir. Bond ka value and all is fixed, correct, no sir. At what value you will buy, what value you will receive and all. So bond is an example of a monetary item. Okay, fair enough. So for that we need three rates basically. Okay, TDSR, SDSR because we will receive interest. That's a settlement. Settlement we need for transaction we need TDSR, transaction date ka spot rate. So when you receive any money, here we will receive interest, right? So that you have to account using SDSR, settlement date ka spot rate. Then you book interest income using effective interest rate. Interest is an income. For all income and expenses, we use average rate that we need. So three rates we need. They have given. The exchange rate on the date of transaction is $1 is 40. So this is your TDSR. And the exchange rate on the date of transaction and at the end of the year, both they have given. So on the date of transaction, it was $1 is 40. At the end of the year, it is 45. At the end of the year, you receive interest. So that's a settlement. So this is your SDSR, settlement date ka spot rate. The weighted average rate is given to be 42. So this is your average rate. So three rates which we wanted, they've given. The entity has determined that it's holding the bond as part of initial investment portfolio whose objective is met both by holding the asset to collect contractual cash flows and selling the asset. So the business model is not satisfied by holding the asset till maturity. Here the business model is satisfied by both holding as well as selling. So it means which business model is getting satisfied here? FVT OCI. Hence, this bond has to be valued under FVT OCI. They only given. In fact, they didn't have to tell this, but they only specified in the question. That is great. Okay, fine. All right. Now means that effective interest and all is irrelevant. No, sir. We value FVT OCI means every year you will show the bond at a fair value, and fair value gain loss goes off to SPA. It's a simple treatment, no, sir. Yes, so correct. But the questions we have done in our regular class, no, it was equity instrument valued at FVT OCI. Okay. On equity, we don't get regular dividend. So the valuation is very simple. All right. And every year, if you purchase any equity instruments as an investment, and if you are valuing such investment at FVT OCI, find out the fair value of that. And accordingly, fair value gain or loss, you transfer it to OCI. Matter was ended. But here, sir, you purchased a bond. On bond, you will receive interest. And that interest is an income. It should be transferred to SPL. Right? And we don't book the interest income on the actual basis. We have to book it on effective interest basis. That means what? That ACM table is still relevant, but for calculating interest. So once again, I tell you, though you are following FVT OCI method over here, the interest income will be still booked using your EIR basis only. That is the same. So if you remember the ACM table, how you used to show? First opening balance, then interest income because this is the financial asset, then receipt, then closing balance. Yes, no. So here after closing balance, we need to have two more columns. Like what? We don't value the investment at closing balance now. We have to value it at fair value. After closing balance, here you need to have two more extra columns. So like this is your regular columns which we used to do in ACM table. Then you need to have fair value. And then you will have some fair value gain or loss. So that extra fitting is there. So even if you are valuing the bond under FVT OCI method, still you need to put up ACM table because the interest income will be still booked on an effective interest rate basis only. So that way this question is good. Okay. So we've done such questions. But in our questions, okay, so whatever question we had done, no, the bonds, we've done same bond wala question only, I think, if my memory serves right. But the bond was not valued under FVT OCI. It was valued under ACM. So it was straightforward. Since here they've brought in one modification saying the bonds are valued at FVT OCI, these two columns becomes extra fitting. That's the reason I'm going through this particular question with you. I'll take you through, don't worry about the stable car data and all, but this is the overall difference in the question we have done in our regular class versus the question that they've asked newly over here in this particular MTP. Okay, we had done ACM, here they've asked FAT OCI. That's the, if I have to tell in one line, what is the difference? Okay, sir, great. Here they'll give an effective interest rate, which is 10% that we needed. Okay, they are asking the requirement, calculate the gain or loss to be recognized in SPL. Interest income goes off to SPL, no? So that is one, that gain or loss. And it's a monetary item. Monetary item, this bond, you have done a foreign currency transaction. On monetary item, you have to restate at closing rate. And any gain or loss, you'll have to transfer it to SPL. So two gains will go off to SPL here. One is your interest income on financial asset and probably exchange gain if you have. If it is exchange loss, that will also be transferred to SPL. Okay, but what about fair value gain loss? That fair value gain loss will go off to OCA. That's the second requirement. What is the gain or loss to be shown in SPL and what is the gain or loss to be shown in OCA is what they are asking us to calculate. Also pass journal entry to recognize gain or loss on above. All this gain is there, no? 3 gains or losses, whatever, right? That entry they are asking me, right? Round off the figures to the nearest rupee. They are only asking you to round off. Great, sir. This question has come for 6 marks. Pretty straightforward question. We'll take you through, okay? Now, I've just done some changes in the evaluation. Just check. So, initial measurement. Initially, all bonds are measured at fair value. What is the fair value? $1,000. So, whenever, in fact, I told you this in Index 21 also. Whenever they give you the data in foreign currency, don't convert it. Put up the ACM table in foreign currency only first. Okay, put up the ACM table exactly in foreign currency, whichever foreign currency they have given, whether it is dollars, pounds, whatever, sterling, yen, doesn't matter. See, you calculate the ACM table in that foreign currency itself. After that, you convert it into Indian rupees. First calculation is always done on foreign currency only. Why? Because each component are converted at different rates. That's the reason. Like, just to give you an example, so opening balance. Opening balance is nothing but your purchased a financial asset. So it should be recorded at TDSR. So this will be recorded using TDSR. Okay, just to give you the context. That's the reason we calculate on each first the data in foreign currency and then convert it into Indian rupees. Now this is your interest income. Interest income you have to use average rate. This is the interest receipt. So it's a receipt. So it's a settlement. Settlement here refers to both money coming in and money going out. So all settlements are recorded using settlement date cost spot rate, right? The closing balance. Closing balance, what's it? It's a monetary item. All monetary item as per Index 21 has to be restated using closing rate, right? So for each of them, the rates are different. Hence, we calculate first in foreign currency. Okay. Then I'll talk about the fair value a little later. What is the exchange rate? Okay, na sir. That's the reason. First, do the calculation. I brought this table also for your reference. Okay. First, do the calculation in dollars, right? So how much is the dollar value of the bond you have purchased? Here only they've told in the question, we purchased this bonds by paying, where is that now? Here, $1,000. So $1,000 is your opening balance. Done. Opening balance here refers to the bonds purchase. That's all. Then interest income. Interest income you will recognize it on effective interest basis, which is given in the question to be 10%. Here only they told EIR is 10%. So calculate 1,000 ka 10% is $100. So all these are dollars. Then receipt. Will you receive? Yes. You will receive the interest. What is the actual interest you will receive? 4.75%, and the interest is not calculated on fair value. It's on the face value. What is the face value we underline? 1250. So 1250 ka 4.7% you do. You will get some amount. Okay, 1250 ka 4.7% if you do, you will get 58.75. But they told in the problem round it off. Since it's rounded off to 59. This around you get 58.75, which is rounded off to 59. Requirement of the question. Okay, if the question had not told, you could have kept the decimal. It's fine. So this is the receipt. And then the closing balance. How do you get the closing balance? These two addition minus receipt. Yes, no, 2 plus 3 minus 4 we used to say. Correct? Yeah. So adding these two and minus this if you do, you'll get $1041 as the closing balance. Yes, Saru. That is one. Done. Now, if the valuation was ACM basis, means you could have stopped the solution here. At closing balance, you could have stopped the table and done the journal entries. But here we are not doing ACM accounting. Here these bonds ka business model is by both holding and selling. So you have to follow FAT OCI method. Okay, and what does FAT OCI method say? At every year reporting period, usually here the reporting period is year ending. So at every reporting period, you have to value these bonds at fair value, right? And do you know the fair value? Yes, the fair value of the bond at year end is $1 is US dollar is 1060 dollar value. The fair value is given to be 1060. So currently the bond value as per ACM is 1041. Can you show it at 1041? No, you have to show it at fair value. So which is what? 1060. That means from 1041, you have to go up to 1060. So it's a happy face because it's a gain. From 1041, you have to increase the value of the investment to 1060. So it's a fair value gain in dollars. So these two combined is how much? $19. So $19 is the fair value gain here. So how will you convert this? So when will you calculate fair value? During the year? No. Beginning of the year? No. You will calculate fair value at what? End of the year. So obviously use your common sense. What rate we need? The closing rate. That's it. So fair value is a closing rate. Means you got fair value gain or loss by using fair value only. No. So for fair value, if you're using closing rate, means the fair value gain or loss also obviously you'll use what? Closing rate. That's it. Done, answer. Now go on converting. That's all. This $1,000 you use TDS. Transaction date ka spot rate. When you did the transaction, it was 40. And at the end of the year, it is 45. So this you use 40. 1000 into 40 is rupees 40,000. This is in Indian rupees. For interest income, we need average rate. What is the average rate we got it? 42 was average rate. So this you multiply by 42. So you'll get 4,200 rupees. Receipt is a settlement. So we need settlement date ka spot rate. You received the settlement at the end of the year. And at the end of the year, the exchange rate was 45. So this you convert using 45, you'll get 2655 rupees. Closing balance. Closing balance, sir, don't just do like this. How did you get this 1041? These two you added and minus this you did and you got 1041. That is fine. That is fine for dollar. But we want rupees now. So this bond is a monetary item. All monetary items should be restated using closing rate. So just like the way you did for dollars, don't do it for INR also. Don't add these and don't minus this. You will not get this value. Okay, because it's a monetary item. That's I've shown that calculation also for your reference. I'll tell you here. Okay. So if you do these two and minus this, if you do, in fact, I've shown this calculation. Check 40,000 plus 4,200 minus 2655. If you do, you'll get 41,545. Okay. These two addition minus this will give you 41,545. You can't take that because bond is a monetary item. All monetary item should be restated in the balance sheet using closing rate. And what is the closing rate? We saw somewhere, no? At the end of the year, the closing rate was here 45 was a closing rate. So you have to convert it at 45 and get 46,845. Now means what, sir? If you do this plus minus, you are only getting 41, but the value we need is 46. From 41, we need to bring up the bond ka value, the investment ka balance to 46. So from 41, if you have to bring it to 46, right? How much is the gain? Since you have to increase the value of the investment, it's a gain 5,200. This is what OTA gain? No, this is a gain due to your exchange rate fluctuation, and this is a monetary item ka exchange gain. All monetary item ka exchange gain loss will be transferred where? SPL. So this particular 5,300 gain will go up to SPL. Journal entry also I will tell you. Okay, sir. Then, so fair value and all this exercise is done at year end. So you convert using closing rate. So closing rate is 45 and accordingly do. Okay, so that's all. Okay, this you can put up this particular table as a working note and do the journal entry. Okay, they asked exchange gain loss ka working, and they also asked you one OCI gain loss ka. So obviously this table only will suffice. If you want, you can put up this. This also has working note number 2. This particular thing what I have shown over here, you can show it as working note number 2, exchange gain. Okay, this is the exchange. You can write exchange gain or loss because we don't know when we calculate working note what we'll get. Only at the end we will get to know it as gain or loss. So you can have both words and then call it as exchange gain. Right, sir? Fine. And this anyway, OCI gain loss, you can get it from the table only. So 2 working notes and journal entry. If you pass, that's good enough. Sir, I have shown you the journal entry for understanding purpose. Each journal entry separately, simple journal entry they have asked. I have shown you for your understanding. But in the solution, they have put a compound entry, and that is a shortcut method. I suggest you follow the same. This is the entry ICA has passed. It is nothing but addition of all this. From here to here, if you add all the entries, you will get one compound entry. But usually we are used to passing the entries separately. So just to keep up that particular process ongoing, I've just done the entries in a simple entry or single journal entry. So let's do that first and then look at the compound entry which our mother body has passed. First, so when you purchase the bond, this is your initial measurement ka entry. When you purchase the bond, what is the journal entry? Sir? Financial asset bond account debit to bank account. Yes. So you purchased it for 1,000. We already converted now. I mean, again, I've showed it here reference, but no need. I've already done it here. How much? 40,000 rupees. So this is done using TDSR, transaction date ka spot rate. Yes. Okay. Then subsequent measurement will start. On this bond, you'll get interest, right? Interest income, right? Interest, not interest receipt. Interest income is accounted using effective interest rate. So what is the journal entry for interest income here? Financial asset account debit, financial asset bond account debit to interest income. You already done that. Interest income is 4,200. So pass this entry. This is done using average rate, which we have converted and also shown here. Yes, sir. Okay. Next, third one is you have received some money. Every year you will receive interest. No? So it's a receipt, right? So what is the journal entry for interest received here? Bank account debit to financial asset bond. We have already converted. How much is that? 2655. Pass that entry. So this is a settlement. So we record using settlement date ka spot rate. Over, sir. Alright. Now, if you add these up, like the way you did for dollars, if you add this 40,000 plus 4,200 minus 2655, if you do, okay, you will get the existing financial asset bond ka balance, which is 41. But bond is a monetary item. As I told, monetary item should be restated every year using closing rate. So if you restate, you will get 46,845. So the required financial asset bond ka balance is 46,845 because monetary item you have to convert using closing rate. But existing balance is only 41. By passing all this journal entry, if you add all this, 40,000 here you have debited, 4,200 here you have debited, 2655 here you have credited. Where and all if you have debited, you should add. Where and all if you have credited, if you minus. So you will get the balance only as 41. But required balance is 46. From 41, you have to bring it to 46. So if you have to increase the value of investment, means it's a gain. So this is the exchange gain loss. It will be transferred off to SPL. How much is that? 5,300. Bond value have to increase. No? So the journal entry will be financial asset bond account debit to exchange gain, and this exchange gain goes off to SPL, which is 5,300. Okay, done. Ends the matter. Sir, if it was ACM accounting, this would have, you would have stopped the solution here. But here it is FVT OCI accounting. Okay, so when you did this, no, the financial asset balance has become 46. Now. After you accounted exchange gain, financial asset balance has become 46,845. But we, as per FVT OCI method, you have to show the value where we should value the investment at fair value. And fair value is what? $1060. And fair value is done at, exercise is done at year end. So use closing rate, and if you do, you get 47,700. Currently, financial asset ka balance is 46,845. From that, you have to increase it to 47,700. So this is what, sir? This is a fair value gain or loss. And since we are following FVT OCI method, this fair value gain loss will go up to OCI. How much is that? 855. So you have to increase the value of investment. So the journal entry will be financial asset bond account debit to fair value gain, which goes off to OCI, which is 855. Okay, we have already done the table working, so no need to show it here. The end point is what, sir? Basically, at the year beginning, you are showing the investment at 40,000. At year end, it will come in your books at 47,700. That's all. From 40,000, it has to become 47,700. That's all. Fine. This is all your journal entry, right? Now, all these are subsequent measurement ka journal entry. From here to here, what and all entry we have passed, no? It is subsequent measurement. This is the first entries for initial measurement. All that is subsequent measurement. What and all entries I've shown it individually here. These three entries, no? Right? We need to combine them and pass one entry because ICA is presenting like that. So I suggest you follow the same presentation. Even if you show separately, in my view, it is the right only. Okay. In fact, that is better because all this transaction will happen at different dates. Yes, no. So it is better. Maybe I don't know. Usually at year end only. Yeah, so it's better to show them separately. But anyway, ICA is recommending a shortcut method. So let's follow. Okay. So what is the one entry you have to pass? Forget the initial measurement. Leave this. Check. In entry number 2, you debited financial asset bond by 4,200. Here you credited by 2,655. Here you debited by 5,300. Here you debited by 855. Add. Where and all you have debited 4,200 minus 2,655 plus 5,300 plus 855. If you do that, you're getting, my calculator is showing 7,700. It has to be 7,700. Why? Sir, you are showing bond initially at 40. Now you have to make it 47,700. From here 40 to 47,700, if you compare, that difference is obviously 7,700. No? Yes. So entry you will pass is financial asset bond account. That's what I've written here. From 40 you have to make it 47,700. So financial asset bond 7,700. Because when you're doing one entry, no, you will not have all this reference point. Correct. No? That is the reason I'm telling you another quick way to figure out the amount. From 40, you have to make it 47,700. So you have to increase it by 7,700. Bond is an asset. Assets have debit balance. To increase it, again, you have to debit. That is one. Okay, what and all you know, first you figure it out. Then you received interest. No? So it means bank you will debit. How much interest you received? 2,655. So bank will be debited by 2,655. Like that. Then interest is an income. Income obviously you will credit. So income you will book it on effective interest rate basis. So in functional currency, what is interest income? 4,200. This is your interest income. Credit interest income which goes off to SPL 4,200. That's it. No, two more. There is an exchange gain loss on monetary item which goes to SPL, and there is a fair value gain loss which goes to OCI. Both are gain. So both should be credited. So how much is exchange gain loss as a working note? Here, this working note, if you just check, exchange gain is 5,300. All gains are credited. So to exchange gain which goes to SPL 5,300. To fair value gain loss which goes to OCI, which table only gives, which is 855. So credit that. If you do this, the journal entry will match out. That's all. So if you want, you can just quickly sum up also. If I sum up the credit side, it is 10,000. 355 minus 7,785 I'm getting. So both the journal entry is matching. So that's all, sir. It is all these three entries ka combination, one compound journal entry they pass. Oh, it's easy, no? So instead of passing 4-5 entries, okay, if I see a saying pass one entry, that is good enough. So we'll pass that. So just the presentation part in exam is only three things. First, put up this one table as a working note. Exchange gain loss as a second working note. Fair value gain loss here only it's captured. So no need for any working note. Then this one entry you pass. Problem sorted, 6 marks. You can do swaha. Okay. That's all is this question all about. Okay. So only one adjustment, that fair value gain loss becomes an extra adjustment here. Other than that, it's a repetitive question only in my view. Okay. So this also in a way is good only. Good question I would say. Done. Okay. Awesome. Hope your understanding is going good. There's no problem, no? Everything is looking good? All right. Excuse me. Okay, sir. 4A is in India is 19. You'll see this as question number 3 in our class note. So repetitive question. Then 4B is in India is 102 share-based payment ka question number 25. This is the same. 5A I will do. Before that, I'll tell all the happy news. 5B is analysis of financial statement ka question number 7. Same question. No change. Then 6A is question number 4 in our professional and ethical duty wala question. 6B is India is 38 intangible assets ka question number 13. Same or similar. 6C is also India is 113 ka question number 5. That means there are only one more question we have in this particular MTP ka. All sort of new questions we would be done for. Okay. So exciting. Yes. In the last phase we are always excited. Yes. Okay, so let's go over question number 5. So apparently this is a 5-marker question it seems. According to me, this should be a lot higher. Okay, but anyways, no problem. A good question in a way. So we'll run through this question. ABC Limited supplies plastic buckets. So that's the goods we are dealing with. As per the contract contract entered into between ABC and customer for financial year 20X1, X2. Okay. The price per plastic will decrease retrospectively as the sale volume increases. So we have done some retrospective contract adjustments with the customer. Like what is that? Like we are telling the customer price applicable for the entire sale will be based on volume. How much price per bucket, per plastic bucket will charge will depends on how much volume customer buys. It's common sense, no? The more and more the customer buys, we will give a discount. But here, we have made an agreement that we will give discount not on a futuristic basis, but on retrospective basis. Meaning, if customer buys anywhere between 0 to 10,000, usually 0, 1 actually, it should be, yeah. Between 1 to 10,000 units, if he buys means, obviously the price will be 90 per unit. On one plastic bucket, we will charge 90. If a customer buys even 1 unit more than 10,000, meaning from 10,000, 1 to 35,000 units if he buys totally in the year, then the price will be 80. For what? From 10,000 to 35,000 will it be 80? No, it's a retrospective adjustment. Suppose customer buys 15,000 units, assumption. 15,000 comes here. That means what, sir? It's not this way. For first 10,000, we will charge 90. On the next 5,000, we will charge 80 per unit. No, on the entire 15,000 units. On all 15,000 units, the price will be retrospectively adjusted. So 15,000 comes in which category? This. So an entire 15,000 units, the price will be charged as 80 rupees. This is what we mean by retrospective adjustment. We have done such question in India is 115. So this is not a new thing to us. Okay, sir. This is what they mean by retrospective. However, if the number of units purchased is more than 35,000, then the price for all the units, even those units which is purchased before 35,000 units also, retrospectively for all the units, the price will be taken as 70 rupees. So this is what we made an agreement with the customer. Great. All transactions are made in cash. No credit basis. That's great. Excuse me. 1 second. Yeah. Sorry for that. Suggest how revenue is to be recognized in the books of ABC. All right. As per the expected value method. So we have two methods, expected value method and most likely method. So here they're asking us to use expected value method. Okay, considering the probability under expected value method, we use the probabilities. So they've given 3 probabilities: 15%, 75%, 10%. Meaning there are sale volume 9,000, 28, and 36,000. Meaning there is a 15% chance that the customer will buy 9,000 units. There is a 75% chance that customer will buy totally 28,000 units. There is a 10% chance that totally customer will buy 36,000 units. It's not most likely. Under most likely method, we use the highest percentage, which is 75, and freeze 28,000 and do the calculation. It is expected value method. So we have to consider all the probabilities and do it. For workings, assume ABC Limited achieved the same number of units to the customer during the year as initially expected or initially estimated under expected value method. Using expected value method, we'll find out one number. No? Using all this probability, we'll find out some unit. For simplicity purpose, they are saying whatever units the entity estimated, same unit customer purchased also. Suppose after using probability, you came to know about certain units. The same units, assume that customer has purchased is what they are saying for calculation purpose. Great. You are also required to pass journal entry and also under expected value method for X1, X2 they have asked. Okay, sir. Now, quite simple. They've given the units, yeah, and they've given probabilities. And expected value method, what do? Units multiplied by probability we do. So this is your units, first scenario. Don't worry about this scenario. This is extra fitting. I'll discuss that a little later. So first we'll calculate the weighted average price per unit considering the probabilities. So sale unit as given in the question is 9, 28 and 36. This is they've given, and probabilities also they've given 15, 75% and 10%. So multiply. So take the selling units and multiply by the respective probability. These two multiplication will give you 1350, these two are 21, these two are 3600, like this. Okay, sir. So that means what, sir? Adding all this. Okay, adding all this. Don't take the highest number over here. That is the most likely method. Okay, in the expected value method, take the total. Total of all this is how much? 25,950 units. Meaning, by considering all the probabilities, we feel the customer may buy 25,950 units. That means this we will take, sir. 25 comes in this category, sir. The price is 80, sir. No, sir. Okay, under expected value method, how the revenue will be booked is, right? We have the probability here, no? This is what, sir? Volume. Do we know the selling price per unit? Yes. Now check. For 1350 comes in which category? 1350 comes in first category. 0 to 10,000 is first category, no? So 1350 means, okay, for 1350 units, the price is 90. Next is 21,000. So if the total units is 21,000, 21,000 comes in this category. For this category, the price is 80. If the total units purchased is 21 means the price will be 80. Next, 70. Correct, no? Yeah, I mean basically the price, it's not the category, sorry, my bad. Yeah, it's the price. For this unit, the price was 90. Here, how the probabilities are considered is, we use the probability not just to find out sale volume, we use probability to find out sale value also. Same drama. So first find out these two you multiply, you will get the probable or you get the weighted sales volume. Okay. So what is that? It's simply taking the units and multiplying by the selling price. So add these two, you will get the respective units. So total units is total weighted, probability weighted selling price or sale units is 25,950. Okay, sir. In the same fashion, the way you did for units, in the same fashion, you have to do it for price also. Do you know the selling price? Yeah, it's not, sorry, my bad. I did a small mistake here. The correction for this, the price is 90. For this, the price is 80. For this, because this is the units, no, it is 70. So you have to do the same calculation and find out that this is what? Probability weighted selling unit. Similarly, we also need to find out probability weighted sale value. How do you get the sale value? Take the volume and multiply by the selling rate. Okay, so 1350 into 90 will give you 121,500. Okay, these two multiplication will give you 121,500. Then similarly, 21,000 into 80 will give you 16,80,000. Then 3,600 ka 70 if you do, you will get 2,52,000. Okay, same the way you do it for volumes, the same thing you need to do it for value also. Okay, like that. Take basically how you get probability weighted sale value. Or if you don't, I've showed this in one table. If you want to prepare a separate table for probability weighted sale value. So how do you do that? First, find out sale value. Take the units, multiply by the selling price. You will get sale value, and that multiplied by the probability factor you do. So 9,000 into 90 if you do, you will get sale value. Sale value multiplied by the probability factor. So basically 9,000 into 90 into 15% if you do, you will get the same answer. Like that, you can calculate the probability weighted sale value also as a separate table. I thought that this will save some time. I put it in one table. Okay, answer. So take this and multiply by the selling price. You will get the probability, because this is probability weighted sale value. No? So multiply by that by the selling price, you will get probability weighted sales value. Okay. So how much is that? Adding all this, you get 20,53,500. So why do we need this? Because whenever they give you expected value method, no, we have to find out some weighted average price. Okay, all these are weights game, right? We have to find out the weighted average price, and revenue will be booked based on this weighted average. It will not be booked on 90, 80, 70. It will be booked on all these are respective units ka selling price. We have to find out under this methods whenever they give you probability. We need to find out weighted average selling price per unit, and the revenue will be accounted using weighted average selling price per unit. That's it. Okay. So how do you get weighted average price? Sale value divided by number of units. So we have to take probability weighted sale value divided by probability weighted sale volume. Okay, so probability weighted sale value is 20,53,700, or in other terms, 20,53,700 is a value for 25,950 units. For one unit, how much is the value? 20,53,500 divided by 25,950. If you do, you will get the weighted average price, because we have assigned the weight over here. Since it is a weighted average price per unit is 79.713. So you will recognize the revenue on one unit at 79.13. That's how this game works. Okay, under this method. Yes, sir. So revenue will be booked on each unit at 79.13. Later we'll have to do some adjustments, which I tell you. So far this is good. Simply find out the weighted average price per unit by considering what? Probability weighted sale units and probability weighted sale value. That's all. For sale value, you have to consider probability. For number of units also, you have to consider the probability factors and get this. That's all. Okay. Yes. Now the entry. Sir, entry you can pass in multiple ways. Okay. So according to me, this would have been the better way of passing the entry, but study material has passed this. Maybe first I'll discuss this, then I will talk about the other one, because that is better. But study material is again asking us to pass the simple entry. Okay, this is little more requires a little more time. They have done that, but maybe this is good for our understanding. So hence I'll start with this. Now, sir, what did they ask us to assume in the question? So how much is the probability weighted sale volume we are expecting? After considering the probability factor, we feel customer will totally buy 25,950 units. A company is estimating that a customer will buy 25,950 units. They asked us to assume one thing. What is that? Sir, whatever assume, check this line once again. For workings purpose, assume ABC Limited, the company, achieved the same number of units of sales to the customer as it was initially estimated. Whatever company estimated, they're asking us to assume customer bought that much only. Okay. Now here, how much are we estimating the customer will buy? 25,950 units in totality for the whole year. And they're asking us to assume customer bought this much only. Okay. Now, and for this, they pass one entry. But you think logically, sir, this is the one-time transaction. No, sir. Obviously, this is a transaction for the whole year. They have given this data for the whole year. Yes, no, sir. This for the whole year. Do you think customer will buy off entire units in one shot? No, right? He will buy, sir. He will buy what, sir? For first week, he will buy 10 units. Second week, he may buy 100 units. The third month, he may buy 150 units. Like this, month on month, a daily basis, weekly basis, he is going to go on placing the orders. Correct? Hence, I have passed the entry this way. Now there is a slab. What is that slab? They have given three slabs, no? 10,000, 10 to 35 and more than 35. Now we are estimating that he will buy 25,950. Okay, sir. And don't take the price to be 80 over here. We have already found out weighted average price, which is 79.13. So revenue will be booked on 79.13. Okay. But first, up to 10,000 units till customer was buying. All right. Do you think for revenue we are considering 79.13? That's okay. But will we collect 79.13 rupees from the customer on one unit? No. Suppose customer buys 1,000 units. First time customer placed the order for 1,000 units. Will we collect 79.13? No. 79.13 is for revenue recognition. What will we tell the customer? Boss, we have made an agreement that anywhere between 0 to 10,000, the price is 90. You have placed the order only for 1,000. 1,000 comes in first category. It has not crossed to 10,000. So please pay me 90 rupees per unit now. Later on, we'll tell the customer, if you buy more than 10,000 units, I will adjust the price. But for time being, you give me 90. Correct? No. Later on, you will do the adjustments. Correct? So all that means when the customer places the order for first 10,000 units, whenever customer places the order for up to first 10,000 units, how much money we'll collect from the customer? 90 per unit, because up to 10,000, the selling price is 90 per unit. Yes, no. So hence I pass the entry for first 10,000 units. So what will be the entry? Bank account debit 10,000 into 90, which is 9 lakh. Correct? No? To what? Since performance obligation is satisfied, since the delivery of the goods is over, we can recognize the revenue. But revenue recognition is based on average price. What is the average price? Weighted average price, which is 79.13. So we will recognize revenue of 10,000 units at 79.13, which is how much? 7,91,300. Got it up? Yeah. But journal entry is not matching. Yes, customer paid us 9 lakh, but we are recognizing only 7,91,300 revenue. So balancing figure will be treated as liability and adjusted later. So the liability balancing figure 108 like this. So up to 10,000 units, the customer purchases the goods. This will be the entry we would have passed. I hope you are good with this. Correct? No. But did the customer purchase 10,000 units? No, they said whatever we estimated, that much only customer bought. We estimated 25,950 units. Okay. So out of this 25,950 units, first 10,000 units entry we have already passed. So what is the balance? 25,950 minus 10,000 if you do 25,950 units minus 10,000 units if you do, you'll get 15,950 units. On 15,950 units, what will be the amount you will receive? When you sell this 15,950 units, the journal entry will pass as bank account debit. Now the customer is smart. What will he tell? Boss. Now totally I have purchased 25,950 units from you for the whole year. Correct? That means as per our agreement, 25,000 falls in second category. So the price should be 90. The price should be rather 80 because it falls in the second category. So what will the customer tell? Obviously the customer will tell, boss, first 10,000 units you collected 90 from me. But we have agreed that if the purchases crosses 10,000, the price will be 80. That means I have paid some extra amount on this 10,000 units. So the customer will ask us to adjust, correct? No. So how much money he will pay? On this 5950 units, we will not say 5950 units into 80. No. Totally how many units he purchased. There are multiple ways to calculate this, your choice, the way you want to do it. Okay. The one way to calculate that is, where is it? It's okay. I think I'll show this. Okay, or maybe I'll show you this way. One way to calculate this is, sir, on this unit, how much is this? 15,950 units. On 15,950 units, the customer will pay 80 rupees. Correct? 15,950, he will pay 80 rupees. How much is that? 12,76,000. That's all? No. On the first 10,000 units, he had to pay only 80, but he paid to us 90. That means 10 rupees he has paid extra. That means how much is that? 1 lakh. On this 10,000 units, he has paid us 90 rupees, but the price for this 10,000 also is retrospectively adjusted and it is only 80. So how much we will adjust? 1 lakh rupees. So that means customer will not pay us what? 12,76,000. From 12,76,000, he'll reduce 1 lakh and he'll pay us how much? 11,76,000. So bank account debit 11,76,000. So this is one way to do it. Or another way to do it is, what is the total number of units? 25,950 units. So on all this goods now 25,950 comes in second category. So for the second category, the price is how much? 80. So 25,950 is the total volume he has purchased, and how much he has to pay? 80 rupees he has to pay. So 25,950 into 80 if you do. Totally the customer has to pay us 20 lakh. If you multiply these two, my calculator is showing 20,76,000. Totally he has to pay 20,76,000. But first he has already paid us 9 lakh. Totally he has to pay. This is the total units. No? So this is the total units multiplied by price. If you do, you'll get 20,76,000. In that 9 he has already paid. So reduce that and he'll pay 11,76,000. Your choice, the way you want to press. Like this or like this. Your choice. Okay. So customer will pay 11,76,000. Done, Azar? Okay. Now is this, initially I booked it as a liability. Is it liability anymore? No, it's all adjusted. So you write liability account 1,08,700. This is like an advance. It has got adjusted over here. Now revenue. So revenue on 10,000 units have already passed. Now the balance units is only 15,950. So 15,950 units. Now revenue we've been booking based on what basis? Average price per unit. What is the average price? 79.13. If you do that, you'll get 12,62,124. Correct, sir? If you do, journal entry will not match. Again, there is a balancing figure. So that we'll call it as liability balancing figure. Because here also we call it as liability balancing figure. Here also liability balancing figure. So what will you do for this liability? All the drama is over. Correct? Now you've been booking the revenue only on 79.83, but is your actual revenue now 79.83 or 80 rupees? That means what, sir? You've been booking the revenue at 79.83, but entire year has passed now. Now the revenue, actual revenue for you is 80 rupees because customer has paid you 80 rupees, the actual revenue. For initial accounting, we need average price per unit. Okay. At the end, we have to do some adjustment. Okay. So the actual revenue for us is 80 per unit, but we have been booking at 79.13. So 80 minus 79.13, how much is that? 80 minus 79.13, if you do, you'll get 0.87. So 0.87 is a revenue. We have booked less. We have booked it at 79.13. It should be booked at 80. So we have booked less. And how many units? On totally 25,950 units. So multiply 0.87 into 25,950. How much you going to get? 22,756. So this much 22,756. That only we are showing it as liability over here. Okay. That much revenue we have booked less. Now all the transaction is over. So now from liability account transfer to revenue. That's okay. So this we need to do. According to me, this is a better way of passing the entry. Okay. Yes, people got it. Yeah. Now our mother body. No, they've not recommended all this. They've said you do it in one simple entry. And it's only for 6 marks, so you don't have to do so much. I feel for understanding purpose, this is better. Now what entry our mother body has passed is how many units totally has the customer purchased? 25,950. So they passed one entry. They've combined all these two entries we have shown. No, they've combined on this 10,000 and this 5950. They have not shown it separately. They've combined it. Okay. So the entry will be what? They have passed the entry directly for 25,950 units. According to me, that's a little off because that's not the way it's going to happen. But any which way, no problem. Let's go ahead with the flow what our mother body has done. So bank account debit. So if customer purchases 25,950 units, how much will he totally pay? 25,950 units. 25,950 comes in which category? 80, right? This category it comes, the price is 80. So that means bank account debit 25,950 into 80, which is 20,76,000. We are passing only one entry, no? So adjustment and all will not come. They are not showing all this entry here, okay? They will not collect 90. They have done directly for 80. They have assumed that one entry they have passed for entire 25,950. Practically, that's not the way it's going to work. So if customers purchases 25,950 units in one shot, then he will not pay us 90. 25,950 comes in this second category. The price is 80. So directly he'll pay us 80 rupees. Okay, sir. Effect is same, but you pass like this only maybe for example. So this is bank. To revenue. Revenue you will book on price or no. Revenue you will book it based on weighted average price per unit, which is what 79.13. So on one unit, the revenue is 79.13. On 25,950 units, how much? So this is the revenue we'll pass. Then the journal entry will not match. There will be a difference. Okay. What will be the difference? Same 20 to 756. If you just check here, also second entry difference is 20 to 756. Same difference you will get over here. Why this difference? Because we've been booking the revenue at 79.13, but the actual revenue is 80 because we are doing the accounting based on weighted average price, and the weighted average price is 79.13. Correct? Right? So revenue should have been booked as 80, but we have booked 79.13. So there is a difference. How much difference? 0.87 rupees is a difference on one unit. How many units totally got sold? 25,950. Okay. So that means we have recognized revenue to less extent. How much less extent? 22,576. So if you do these two multiplication, you will get 22,576. So that you have shown as balancing figure now. This much revenue you have shown less. Hence from liability account, you transfer it off to revenue. This entry they have passed. I started with 10,000. I feel this is more logical, better. Okay. But they have directly started and passed the entry for 25,950 units. For example, you pass this only better. Okay, why to override study material? But finally, whether you do this way or you do this way, final answer will still be the same. There will not be any change. Okay, Saru. Okay, I've just told the justification why I've done like this. Okay, that's all it is. Okay, the me justifying or passing the entry like this is customer. The institute has assumed that the customer will buy 25,950 units in one shot. Practically, do you think? No. This agreement we have done it for whole year. So he will buy the units in installments, 100 units, 150 units, 1000 units, like that. He'll go on placing the orders. That means initially he will not cross 25,950 or in one go, right? He will first May when he places only 1000 units. 1000 units comes in first category. So we'll collect 90 rupees. That's the reason I've assumed like that. On first 10,000, the price we'll collect from the customer is 90 and then go on adjusting that. So according to me, this is a better way of routing. But exam, follow this. Okay. Alright. So that means problem over. Sorry, sir, this question ka solution is this all. So you put up this working note, you put up these two journal entries, we are done. Marks is over. But I think similar question had come in November 2020 paper, if I'm not mistaken. Okay, there it had come for 10 mark. Okay, this we used what method? Expected value method. There is another method, most likely amount basis, right? So in this particular question, this question is over. I'm doing this little extra for you now because the same question had come in November 2020 with both. And this is your expected value method. This is your most likely amount basis. Instead of expected value method, if there is most likely method, in that case, how you would have booked the revenue is another requirement which I'm showing you to you for your reference. Because in your attempt, if they ask both and ask for 10 marks, we need to know, right? So let's solve off that also. So if most likely amount is used, okay, then what's the same assumption? What assumption? Whatever company is estimating that how many units customer will buy, customer purchase that much only. 1 second. How many ever units customer, the entity estimates customer will buy, because this is also an estimate, no, right? The whatever estimates the company is doing, the same requirement was given in that question also. Whatever the assume company achieved the same number of units as initially estimated. Okay. Now we are using most likely amount basis. Now how does most likely amount basis works? So check, sir. We have given 3 probability. Most likely amount works on the highest probability basis. Now we have 3 probabilities: 15, 75, and 10. Which is the highest probability? 75%. And what, sir? We have a 75% chance that we will achieve how much? There is a 15% chance that the company will achieve 9,000 units or the customer will buy 9,000 units. 75% chance that the customer will buy 28,000 units. 10% chance that the customer will buy 36,000 units. Correct? Now, so among this, which is the highest probability? 75% chance. That means there is a 75% chance that the customer will buy 28,000 units. So highest probability is 75%. And for that highest percentage, the sale expected is 28,000 units. Okay. So under most likely amount, no probability. This only we will take off. Okay. So the company under most likely amount, the number of units customer is expected to buy itself is 28,000 units. No extra probability. That highest probability wala sale only you take, that only becomes your estimate. Okay. Since the highest probability is 75%, And at 75%, there is a chance that customer will buy 28,000. So the conclusion is the company is estimating that the customer will buy 28,000 units like this. Okay. And the 28,000 comes in which category? Second category. For second category, what is the price? 80. That means the revenue per unit will be booked at here 80. So weighted average price per unit is only required for expected value method because we have to consider all probability, both for units as well as for value. Under most likely amount basis, okay, we take the highest percentage of probability and take that sales at the highest probability itself as units expected to be purchased. Okay, and here since this is 28 and at 28,000 the price is 80, the revenue per unit itself becomes 80. Now for this, what journal entry will pass? I will pass the entry like this only. Okay, now revenue per unit is 80, correct? All right. Now on the how many units we are expecting the customer will buy? 28. Do you think customer will place the order? One order he will place for 28,000? No, he will go on placing the order throughout the year, right? But up to 10,000 units, we have made an agreement that the price will be 90, correct? That means for the first 10,000 units, when customer places the order, the company will collect on one unit how much? 90 rupees. That's what I've written over here. On the first 10,000 units, the selling price will be taken as 90 per unit. We will collect 90 from the customer. So the journal entry will be bank account debit 10,000 into 90, which will be 9 lakh. To what, sir? Since 10,000 units are delivered, you can performance obligation is satisfied. So can you book the revenue? Yes, but revenue will be booked at 80 per unit. Yes, because most likely amount basis. So revenue 10,000 into 80, which is 8 lakh. Customer paid us 9, but we are recognizing revenue only to the extent of 8. Balance 1 lakh is liability. We'll book it as balancing figure liability and adjust that liability later. Okay, sir. Now balance. What is the balance? In this 28,000, 10,000 units he has already purchased. The customer has already purchased. So the remaining is what? 18,000 units. 28 minus 10, which is 18,000 units. This you can show the multiple ways, like the way I've said. Bank account debit. How much will the customer pay? Now the customer has totally purchased 28,000 units, correct? And if it is 28,000 units, 28,000 comes in this category. So what will the customer say? I purchased totally 28,000 units. So that means the total price is on one unit it is 80 rupees, correct? No? On one unit it is 80 rupees. On 28,000 how much? So 28,000 into 80 if you do, the customer is saying I have to pay you 22 lakh 40,000. These two multiplication will give you 22 lakh 40,000. In that first only he has already paid. On first 10,000 he has already paid 9 lakh. So in this 22 lakh 40,000, 9 lakh is already paid. So minus 9 lakh, how much will be the balance figure? So 13 lakh 40,000. Then the customer will pay. This is one way of showing. Or you can say other way also. On this 18,000 units, now 10,000 units is already crossed. So on this 80,000 units, the customer will pay only 80 rupees. But on this 10,000 units, customer has already paid 90, but he should have paid only 80. That means on this 10,000 units, he has paid 10 rupees extra. That means he has paid 1 lakh rupees extra. So that way, if you adjust and calculate also, you'll get the same value. The way you want to calculate, your choice. So bank account debit 13 lakh 40,000. So initially you book this as the liability. Now this has to be adjusted. So liability account, you have credited here, adjusted by debiting it. To what? To revenue. You have already recognized the revenue on 10,000 units here. Now additionally, how many units are purchased? 18,000 units. And what is the revenue per unit? 80 rupees. So to revenue 18,000 into 80, which is 14 lakh 40,000. That way, this particular problem is got adjusted. Okay, so this is a lot easier and easier way. Okay, this you have to calculate. This is also easy only, just that you have to calculate one extra fitting called weighted average price per unit. Remember, you have to multiply probabilities both for the value as well as for the volume. Consider that and get weighted average price per unit. Okay, sir. Based on that, you go on passing the entry. Yes. So this is not asked, mind you. This is just for your reference, which we did in case if it comes. Done, sir. So with this, even this particular question is done, and the remaining, as I told you, I think I'll quickly just check. Yeah, remaining is already there as part of our regular notes itself. Yes. So with this, all the question relating to this MTP we have covered. Thank you so much. Take care. Bye bye.